By the time Bitcoin was entering its fourth year of existence, something extraordinary was about to occur. An event written into its very code, a mechanism that would define its economic character for decades. The halving. Unlike any central bank policy, government decree, or stock market maneuver, the halving was automatic, pre-programmed, and inevitable. It was Bitcoin's silent clock, ticking down every 210,000 blocks, halving the reward miners received for securing the network. This was the moment when Bitcoin's scarcity would become real. What is a halving? For those outside the cryptosphere, the concept can seem abstract. Every 10 minutes, a new block is mined. Each block originally rewarded miners 50 BTC. After 210,000 blocks, roughly 4 years, the reward is halved. Thus, in 2012, miners' rewards dropped from 50 BTC to 25 BTC. In 2016, from 25 to 12.5 BTC. In 2020, from 12.5 to 6.25 BTC. And so on, continuing until all 21 million Bitcoins have been mined. This built-in scarcity was Bitcoin's most revolutionary feature. Unlike fiat currencies, which governments can print at will, Bitcoin's supply curve is predictable, fixed, and deflationary by design. The first halving, November 28, 2012. By late 2012, Bitcoin's community had grown but was still small. Miners, mostly hobbyists, were running their nodes in basements or on home computers. The first halving approached quietly, unnoticed by mainstream media. When block 210,000 was mined, the reward automatically dropped from 50 BTC to 25 BTC. For miners, this was a shock. They would now earn half as many coins for the same work. Yet the market responded strangely. While some expected panic, Bitcoin's price held steady and even began a slow ascent. By the end of 2012, BTC had climbed from about $12 to $13–14, and the foundations for the 2013 bull run were laid. The first halving demonstrated a critical lesson. Scarcity matters. Investors, even those who didn't fully understand Bitcoin's mechanics, began to appreciate that the future supply was limited. Psychology of scarcity. Halving is more than math. It is psychology. Miners faced reduced rewards, yet the market often anticipates this. Traders buy in expectation of scarcity-driven price increases. Media coverage grows. Speculators speculate, early adopters hold, and fear of missing out drives attention. In this way, each halving became a self-fulfilling prophecy. The halving did not create value directly. Bitcoin AS code cannot magically make a coin worth more, but it concentrates belief, which in turn affects price. The second halving, July 9, 2016. By 2016, Bitcoin had matured. Exchanges were more robust, wallets more user-friendly, and the community larger and more global. Mining had moved beyond laptops and CPUs to dedicated rigs and massive mining farms. When block 420,000 was mined, the reward fell from 25 BTC to 12.5 BTC. The halving was met with speculation and anticipation. The market responded with volatility, a mix of excitement and caution. Price had been hovering around $600 to $700, and within a year, Bitcoin embarked on a historic bull run that would climax in December 2017 at nearly $20,000 per BTC. Investors began to notice the pattern: halving, scarcity, price increase. While correlation is not causation, the psychological and economic effects of the halving became undeniable. Mining and halving economics. Halvings put miners to the test. Profitability suddenly dropped, forcing less efficient operations to shut down. Only miners with cheap electricity, efficient machines, or strategic planning survived. This natural weeding out strengthened the network. Fewer but more professional miners meant more secure, reliable processing of transactions. Bitcoin's incentive system, written in code, ensured resilience. Halving also highlighted a fundamental truth: Bitcoin rewards patience and foresight. Those who held through volatility and believed in the protocol's design were rewarded, while those chasing short-term gains were often left behind. The third halving. May 11th, 2020. The world had changed drastically by 2020. Bitcoin had seen massive cycles, exchanges were sophisticated, institutional interest was rising, and miners operated industrial-scale facilities in China, the US, and Europe. On May 11, 2020, block 630,000 triggered the third halving. Rewards dropped from 12.5 BTC to 6.25 BTC. The event coincided with global economic upheaval caused by the COVID-19 pandemic. Bitcoin's narrative as a hedge against inflation and financial instability became louder. Scarcity was no longer theoretical. It was measurable. The halving was an inflection point, signaling that Bitcoin's maximum supply would be reached slowly over the next century. Why halving matters to investors. Each halving reminds the world that Bitcoin is finite. Unlike fiat currencies that governments can inflate away, the total number of Bitcoins is capped at 21 million. This predictability creates confidence for long-term investors. Halvings also create historical price patterns. While not guaranteed, they have often preceded bull markets. 2012, 2013 bull run, 2016, 2017 bull run, 2020, 2021 bull run. Market analysts watch halvings closely, trying to forecast the next surge. For many, it's not just about technical analysis, it's about trusting the code. Halving as a symbol. Bitcoin's halving is more than a monetary event. It is symbolic. It represents discipline in design. The protocol cannot be changed to issue more coins. It embodies decentralized commitment. No central authority decides supply. It reinforces long-term vision. Bitcoin rewards those who think in years, not days. In every sense, halving is Bitcoin's heartbeat, a pulse reminding the world that this is money on its own terms, obeying rules written in code, not whim or politics. Looking forward. As the fourth, fifth, and eventually final halving approach in future decades, the story will continue. Bitcoin will become progressively harder to mine. Fewer coins will enter circulation. Scarcity will rise, and so too will the stakes for miners, investors, and regulators. Yet through every halving, Bitcoin has survived, grown, and proven that a self-enforcing monetary system can exist outside traditional institutions. The halving is a ritual. It is a challenge. It is proof that code is law and that scarcity, programmed, predictable, unstoppable, is a force the world cannot ignore. Bitcoin had moved from infancy into adolescence. Its first halvings had shaped its identity, economics, and culture, and the world was beginning to understand. This was no ordinary currency.